Hi folks, Chapter 8, we're going to be taking a look at a little bit more about individual income tax and credits. So as I mentioned before, they give you a big overview and then they go through a little bit more. Some of it might seem repetitive, but frankly, that's the way you learn tax. All right, so the first thing, we're going to take a look at regular tax liability. Then there's something called alternative minimum tax, okay? It's kind of a complicated thing. By the way, this is usually people that have a lot of capital gains. They sometimes fall into this, okay? And we'll take a look at that. Self-employment stuff, a little bit about child tax credit and all that kind of thing, and other penalties, underpayment, things like this, okay? All right, so first thing, for regular taxes, we know filing status is probably one of the single most important things. And we know we got married filing jointly, that's MFJ. Okay. Qualifying widower or surviving spouse, I don't know. They used to call this SS, surviving spouse. I don't know if they still do. Married filing separately, MFS. Head of household, HOH, and single is just S. Okay. And by the way, so we have progressive tax rates. I'm sure you probably already knew that. And there's tax rate schedule and tax tables. Now, back in the day, I remember we did a problem in class where they literally had all the tables printed out. And it said from this dollar to this dollar. Now, more oftentimes in books, you see the type we do where it's a base amount and then a percentage. But they literally used to print them all out. It's pretty crazy, but I don't think they do that much anymore. All right, so here are the brackets. Tax brackets or marginal rates. This is on ordinary income, okay? Notice it goes up to 37%. Remember, corporate tax is at 21%, okay? So 10, 12, 22, 24. And then is there a marriage penalty or is it a benefit, okay? So who's more likely to have a penalty, potentially pay more? That's if both spouses receive income. Who's likely to benefit when only one spouse receives income? So, frankly, whether or not there's truly any benefit anymore, it's hard to say. It really depends upon your individual situation. And frankly, sometimes depending upon what happens, sometimes you need to actually calculate the married couple together and then calculate it separately to see which one is better for them, okay? Now, here's some exceptions to the basic tax, okay? And again, these you would know. Long-term capital gains, okay? Generally 0, 15, 20, but can be as high as 28%. And two different tax rates on one gain is possible. It's like if you happen to split that category, okay? Dividends, again, generally at 0, 15, or 20. And again, two different rates is possible to happen. Again, that's when you're right on the cusp, okay? And so part would be at one tax rate and part would be at another, okay? Kiddie tax, we've also discussed this. Notice, this is unearned income. Unearned income tax at the parent's marginal rate. And again, the reason why was, the government had to come up with this because before people would take their investments and put them in the kid's name. And so this is based on unearned income in excess of $2,600. Now, here's the key. Unearned income. Unearned income, okay? Basically investment income, all right? So here are the rules for that. If you're like, well, what are those particular rules? Number one, child has to be under the age of 18. The child is 18 at year end, but earned income not greater than half the child support, or child is over 18 but under age 24 at year end, is a full-time student during the year, and the child's earned income not greater than half the child support, excluding scholarships. Okay, so either one of these two items here can apply. Okay, so here's an example. Let's say Courtney's taxable income is $561,350, including $15,000 of qualifying dividends taxed at the preferential rate. What would Courtney's tax liability under these circumstances be? Okay, so they're just asking for a straight tax computation. Okay. So here it is. Here's a 162,655. If you're like, well, how'd they get that? Well, there's their taxable income. Subtract out these preferentially taxed dividends, and this is her ordinary rate income. Now, what do? You look it up on the chart, and it's 53,997 times the difference between these two times 35%. It does say, and here they said using head of household. Okay, so head of household. Okay, and now taxed at preferential rates. What winds up happening here, 5,000 of that is going to wind up being at 15%, and 10,000 of that is going to wind up being at 20% because she's right on that cusp. So you can see here is the taxable amount right there from that. So here's the total tax. And I think on the next slide they detail it. Okay, so 10,000 of her income, 10,000 of her dividends fall to the 20% preferential tax bracket. 561,350 minus 551,350. That's the end of the 20% bracket. Okay. The remaining 5% is taxed at 15%. Okay, and that's from 63,000. Look how crazy this is. From 63 to 551. Okay, so see, because she's right on the cusp, we'll take a look at these two numbers. So 5%, 15% here, and then anything above this then goes to 20%. This is one of those parts where I generally have a big disagreement. There's a world of difference between people making this different amount of money here. Okay, there's no way this should be the same. I don't know what they should be, but they should not be the same. Somebody making $551,000 versus somebody making $63,000. That's like what, 9 times the amount? Yeah, about 9 times the amount. Anyway, that's tax. Sometimes it's not fair, but okay. Net investment tax. Now, net investment tax is 3.8%, and it's based on the lesser of the income from these items, okay, and or excess of modified AGI over 250,000 for married filing jointly, 125 for single, and 200,000 for others. So what this is, they're taking a look at an additional amount of tax that's possibly imposed. Basically, it has to do with excessive investment income, and it's the government's way to capture more money back. Okay, so here, now we're going to take a look at a kiddie tax example. It says during 2024, Duran, I guess that's a child, received $5,500 in interest from an IBM bond, and he received another $2,100 in a money market account that his parents have been contributing to over the years. What is Duran's taxable income and corresponding tax liability? His mother is at 24%. Well, if you remember, the key number here was $2,600 unearned, right? So let's see the calculation. Okay, because he's younger than 18 years of age, and his net income, he is subject to the kiddie tax, $2,600. Okay, talked about that. So here's his gross AGI. This is his interest from the IBM, and this is his other interest. Total of $7,600. The standard deduction, and again, this is minimum for taxpayer claim as a dependent on another's return. Okay, no earned income, so you must use the minimum. That's this amount. Okay, otherwise you would use the earned income. So taxable income is $6,300. Okay, gross unearned income minus $2,600 is $5,000. Right? Net unearned income is $5,000. So you would take number 5, that 5,000, times 24%. Okay, gives you that $1,200. Taxable income at Darren's rate is the other $1,300. He's at 10%, so that's $130. So you add these two together to get this. This is at 24%. And this piece right here is at 10%. And that's because of the kiddie tax. All right, folks. Part 1 from Chapter 8. Back with Part 2 in just a minute.